Hello everybody, Kirk Spano here. Today I am releasing the interview that I did 2 months ago with the CEO of Aemetis. I held on to this as subscribers to my investment letters and my clients at my investment advisory were accumulating the stock. And I'm releasing this now because it seems like we've almost got our fill, but also the stock price is down. So I wanted to release this at a point where people wouldn't be saying, oh, you're just trying to push this up. No, I want you to get it at about the same price that we did. After cash secured put assignments, my net cost is right around $8 a share in some accounts, up to about $12 a share in other accounts. So that $8 to $12 range, which is where the stock is now, drifting higher on the Ukraine crisis, makes it, I think, a buy on any pullbacks. So I want to introduce you to the company that has made tremendous progress. What you're seeing on the screen right now are some of the PR releases. Go to the Aemetis website and take a look at these more close up. But things that we talk about in this interview subsequently happened over the next 2 months. So this company is executing. They are growing. They are signing deals to sell more of their jet fuel and preparing, I think, for an opportunity to grow a lot over the next 5 years. And what's interesting is that at the end of those 5 years, their CapEx spending will have been coming down quite a bit. So they're going to be in this period where the naysayers are going to say, oh, look at all the expenses, and they're not generating a lot of profits. But one line is going to go one direction, and one line is going to go the other direction. So think about it as when the market recognizes that, hey, these guys are growing fast and their CapEx is coming down. And that crossover point doesn't come for a few years, but the market, of course, is forward-looking. I expect this stock to rise probably to at least $6 billion in market cap and potentially 8, 9, 10 billion in market cap by the late part of this decade, middle to late part of this decade. There was a deal, Chevron buying Renewable Energy Group, that shows just how hot this sector is of the market. So I would consider the numbers that Aemetis looks like it's going to put up versus what Chevron just paid for Renewable Energy Group, that I don't think was anywhere near as good a position. So take a look at the business model here at Aemetis and then think through how the numbers shake out. And it's hard not to come to the conclusion that this is a potential 10-bagger. And I don't think that it even has that much risk. The short-term volatility is going to give you opportunities to buy. There's some financing hurdles that they still have to get over, but they're relatively minor. They have good partners on that. So I think you're probably going to see a heck of a rally here from Aemetis over the next 4, 5, 6 years. If you are the type of person that likes to hold things for a while, look for entries on this one. So with that, let's get to the interview. Look forward to answering any questions in the articles that I release about this company. Good afternoon, everybody. This is Kirk Spano, and I'm with the CEO of Aemetis, Eric McAfee. So I want to talk a little bit about what is Aemetis and why is it at the front end of what I think is a major energy transformation. Eric, how are you doing today?
Doing well, thank you, Kirk. I appreciate the time this afternoon.
Any time that we can get it from the horse's mouth, right? That's great for investors. So I do appreciate it. Can you just kind of give me the overview, the 30,000 foot look at Aemetis, and then we'll go through some of the details.
Well, Aemetis was founded about 15 years ago, and we have grown to be the largest ethanol producer in the state of California, in our ethanol plant based in the Central Valley, just about 75 miles south of Sacramento, California, and almost directly east of San Francisco. We also have a 50 million gallon capacity plant in India that we built and have now grown into being the largest biodiesel plant in India. The India market is a growing market, but it's very relevant to providing the feedstock for the aviation fuel and renewable diesel plant that we're building near our ethanol plant. So there's a big synergy between our position in India, which we built over the last 15 years, and our position in California, which we're expanding. We have announced a total capacity of 90 million gallon sustainable aviation fuel and renewable diesel plant, approximately 50% of each product. And related to that, have signed over $2 billion worth of agreements with airlines, have another $2 billion coming, and have signed over $3 billion worth of renewable diesel agreements with a truck stop chain that's a national chain to supply renewable diesel into the truck business. So we're expanding what essentially was a footprint of an ethanol plant into sustainable aviation fuel and renewable diesel, but also into biogas. We have over 80 dairies that are customers of our ethanol plant, and we have been supplying them for approximately 10 years with about 2 million pounds per day of animal feed, which is a byproduct of ethanol production, and feeding over 100,000 dairy cows in that process. So as we have been working to decarbonize or reduce the carbon in our fuels, to use dairy biogas, the waste product comes out of dairy lagoons, as a truck fuel, is a very, very significant business opportunity. And so we went out and have signed over 22 dairies, on our way to 52 dairies, have completed phase one. We're well into completion of phase two, and we'll be building a business that is about a 35-year relationship with each dairy. And we are capturing the biogas, pipelining it to a central location, cleaning it up, and then we can monetize it, make money on it, one of three ways, one of which is a pipeline, another one's used in our plant, the third is actually fuel the trucks that we operate our business on, and other local companies operate their businesses on. So we're expanding what essentially was a corn ethanol plant into the things that are the inputs of the corn ethanol plant and the outputs of the corn ethanol plant, and optimizing both of them led us into some very strong growth areas in biogas, aviation fuel, and renewable diesel in the California market, which is really arguably the most valuable market in the world for low carbon fuels.
Right, and that's largely because of some of the tax incentives, as well as it seems like you have a number of things lined up in your favor from the geography of where the farms are to the pipeline system. Can you just walk us through kind of that virtuous cycle that seems to be in that little part of the world, which is a pretty big part of the world?
Yeah. The Central Valley of California, where I grew up, actually. I grew up on a farm west of Fresno, which my brothers and our wives and now nephews and nieces and children have built up into a significant farming and dairying enterprise. That area is a former inland ocean, and it stretches from south of Bakersfield to north of Sacramento. And it's about 50 miles wide at its widest. And it has 7 trillion acre feet of water underneath the ground. Underneath our ethanol plant, for example, you go down about 15 feet, you're going to hit water. And it, as a result of the water situation, as well as, quite frankly, the weather, in the wintertime, there's a lot of cold, but not a lot of freezing, because it has fog in the area. In the summertime, it doesn't have the scorching heat of Mojave Desert, which is on the other side of the Sierra Nevadas, but it gets a lot of heat units in the summertime. So very hot, but not scorching. So almonds need a lot of cold units and a lot of heat units without freezing and without scorching. And the Central Valley of California, as a result, generates over 99% of all the almonds in North America, and 82% of those in the world. And that means you have an almond orchard environment, which is 1.5 million acres of almonds and walnuts with a defined life of about 20 years. So 20 years from now, you know that an orchard field that was planted this year is going to be removed, which gives you a feedstock stream of renewable wood. And that wood, unfortunately, has no good use in the market today. You largely burn it in the fields, creating air pollution and CO2 emissions. So a core part of our opportunity is, how do we use wood that is the same kind of wood that comes out of a forest? There's no dramatic difference. But in this case, it's a forest that always burns. Think of it that way. Guaranteed that if you can't find an alternative use for that wood, you're going to do the same thing 20 years from now as what you do today, which is burn it in the field. And so finding alternative use for the sugar that's in the wood, about 55% of orchard wood is comprised of 2 different types of sugar. And then also what to do with the remaining, what's known as lignin primarily, what to do with that is one of our big business opportunities. And so what we did was we said, well, let's take the sugar out and start to replace the corn in corn ethanol, because the 6-carbon sugar is the same kind of sugar we use to make corn ethanol. And we can even upgrade and use the 5-carbon sugars. We can use both kinds of sugars to make corn ethanol. That's a tremendous cost reduction. We spend over $150 million a year buying corn. And if you can get it essentially for free, because it's a waste product of our local almond business, that's a tremendous cost reduction. The second thing is the carbon reduction. Carbon intensity of orchard wood is a negative number because you're not burning it in the field. And so we get a more valuable biofuel made from an orchard wood sugar than we do from corn sugar. But you end up with a big waste stream. The lignin and the unconverted sugars are unusable. So what do? We said, well, let's go use them to make something valuable. And there's only 3 inputs to making aviation fuel and renewable diesel. They're all made in the same plant. They literally come out of the same process. The first thing you need, frankly, is hydrogen. Well, if you can get that hydrogen from the orchard wood instead of from petroleum natural gas, you have a significant cost reduction and carbon intensity reduction. Petroleum natural gas is positive 100 carbon intensity. Orchard wood starts with a negative 100. So you have this enormous benefit of using low carbon, low cost waste feedstocks instead of high cost, high carbon petroleum natural gas. So making the hydrogen from orchard waste wood, getting the electricity from a hydroelectric dam from basically a water source, and then low carbon renewable oils, including ones made by our ethanol plant, allows us to make a very low carbon biofuel. And then by doing carbon sequestration, basically putting the CO2 into the ground that comes off the process, you end up with a carbon negative aviation fuel and renewable diesel, which has, I think, had a material impact on our ability to sign these very long-term contracts with airlines up to 10 years of supply. But they're looking at it as taking a low carbon waste inputs that are obviously environmentally very beneficial to the Central Valley of California by not burning it in the fields or otherwise causing air pollution and health problems, frankly, for people in the Central Valley.
Yeah, that stuff's all amazing. You know, I went to CES 2020, Consumer Electronics Show in Vegas 2020, and I was pretty impressed with some of the technology coming out, and some of it had to do with carbon sequestration, carbon capture, things like that. My subscribers and clients will know that I think one of the most impressive companies out there is Delta. Mm-hmm. And Delta has been very forward thinking, very smart with their management. They've gotten into fourth industrial revolution technology as an airline company. And I don't think that many people understand this when they invest in, say, Delta, what they're getting from the management team. So when they jumped on board with you, I mean, I immediately looked, I was like, well, Delta's doing this with this guy, so I better pay attention. You got American Airlines involved, and I think that that's impressive. The I don't know if it's truck stops or what kind of company it is, but my subscribers know that a few years ago, I invested in a company called Travel America, symbol TA, when it was, I don't know, $4 a share, because they were converting into a C corp and doing some things with the company. And what led me there was I thought that maybe I would just buy myself a truck stop, because I see the fueling for not only heavy vehicles through the biodiesel, but maybe hydrogen someday. And of course, these places have the type of footprint where you can throw solar on and put your superchargers in. I just thought it is a good long-term investment. So I'm pretty sure you can't tell us who the company was that you just did the newest deal with, but I think it's pretty interesting that you have these types of companies jumping in with you at such an early stage. Is there anything more that we should kind of be looking at when it comes to the fueling of the truck fleets?
It definitely is interesting to note that truck fleets today are largely fueled with diesel. Increasingly, trucks are being fueled by renewable natural gas. And I mentioned we're building a renewable natural gas business. We have an approval of a negative 426 carbon intensity, which is among the lowest carbon intensity fuel in the world, certainly for trucks. But if you go to a truck stop, you today don't usually see a renewable natural gas or compressed natural gas pump at a truck stop. But in the future, you increasingly will. And so what they're looking for is they're looking for a supplier who is going to be able to provide large volumes of fuel for truck stops. They tend to be very large volume locations. And so a business opportunity for us all is to have relationships between producers like ours and truck stop chains. So already signing a $3 billion contract for renewable diesel with a truck stop chain put us in a unique position to be able to expand into renewable natural gas fueling for truck stop chains, which I think is just logical. Where are the trucks? Where are they getting fueled? Well, it's not the corner gas station where you take your car. It's the highway-based large capacity truck stops. That's what's fueling trucks. And so that's where the renewable natural gas for trucking really needs to be dispensed. I would mention one other thing for trucking, and that is decarbonizing trucking is difficult. You can't put batteries into the trailer of a truck without replacing cargo. It's not just the size, it's the weight. Trucks are limited on how much weight they can carry on a road to usually 80,000 pounds. And so if you take a 10,000 pound battery system and put it on a truck, you're reducing how much cargo you can haul from maybe somewhere around the 40, 50,000 range down to 30 to 40,000 pounds. Well, that's a 20 or 25% reduction in the amount of cargo you can carry. That means a 25% reduction of revenue. If you take any business, you take 25% of the revenue away, that might be 100% of the profit. Right. So there's a significant impairment that happens in trucking when you just say, well, I'm just going to load up with a bunch of heavy batteries. I'm going to try to find some way to charge them. They're going to take a lot of size. So, got a capacity issue here. There's some real significant challenges I don't think people have spent enough time thinking about. But here's what's interesting. A 90% efficient drivetrain, in other words, the electric motor going to an electric axle turning the wheels, is a very good way to reduce your maintenance costs. And it gives you very high pulling power, high torque, because electric motors have the same pulling power at 1 mile an hour as they do at 50 miles an hour, as they do at 100 miles an hour. It's a flat torque curve. So the real question in a truck isn't, are you going to have an electric truck? Of course you are. Of course you can have an electric drivetrain as they come down in cost, the tremendous maintenance savings and performance improvements. The question is, where does the electricity come from that powers your electric motor? That's the relevant question. Does it, for example, come from a coal mine in West Virginia, processed in a coal burning plant in Illinois? Because if it is, your coal-powered electric truck now has a terrible carbon footprint and doesn't generate any low carbon fuel standard value at all because you're running off coal. It's new coal from the new carbon from the ground going in the atmosphere. You're just siphoning carbon from the ground in the atmosphere. Obviously, a coal-fired truck isn't going to help the environment much. How about the other one? Petroleum natural gas. Where does petroleum natural gas come from? It comes from underneath the ground. So when you burn it, where does the carbon dioxide go? Up in the atmosphere. So if you're just siphoning carbon out of the ground, stuffing in the atmosphere when you run your truck on electricity from petroleum natural gas. So an obvious point would be, that's interesting. You also have to plug in every time you want to get electricity from that coal plant or from that petroleum natural gas plant. You got to build an entire industry of places where trucks sit for 4 to 6 hours in a day to be plugged in. That's not cheap. And certainly you need power created to do it. Is there a way to avoid that entire problem? If you just back up and think, all I'm looking for is an electron, I'm just looking for the electricity and I want it on board the truck. Well, you're kind of answering your own question when you say, how about an onboard charger, not an off-board charger you got to go park next to and sit there and wait and have 3 hamburgers while you're waiting for your truck to charge, but an onboard charger. So how could you fuel an onboard charger in something that's a low carbon fuel, not a petroleum carbon in the ground that goes in the atmosphere when you burn it, but something maybe where the carbon was the atmosphere? Sounds a whole lot like renewable diesel, sounds a whole lot like ethanol, sounds a whole lot like renewable natural gas. Are 3 different fuels where the carbon all came from the atmosphere and could be used to run an onboard charger for a truck. And what we just defined, in my view, is the obvious next step for trucking. Because once you start using low carbon fuels in an onboard charger, it's basically just a generator, but all it's making is electrons that go into the electric motor or into the battery system. You're able to reduce the size and weight of those batteries significantly because you're carrying your energy very densely, and it's renewable energy. It's not coal and it's not electricity that came from petroleum, natural gas. It's not carbon that's in the ground that you're spewing in the sky. It's literally carbon from the atmosphere. And in California, we already have a very developed regulatory system called the Low Carbon Fuel Standard that directly compensates you in cash every single day if you take carbon from the atmosphere, let's say through a plant that's growing for 20 years called an almond orchard, and you use that to make your fuel. And that fuel in an onboard charger charges your onboard electric motor in your truck. You now have a very, very low cost fuel, potentially zero cost fuel using renewable natural gas because of the fact you're using a waste product and it's carbon negative and it's structured to be a very low cost fuel. So I think increasingly over the next year or two, you'll increasingly see people understand that certainly you can electrify trucking. You should, but that doesn't answer the question of, do you want to use coal and petroleum natural gas to make the electricity? The answer there should be no. The answer should be no. That's carbon in the ground. Why are we sucking carbon out of the ground and put it in the sky? We should suck it out of the sky and put it in the ground. And that's what Aemetis does. We sequester the carbon dioxide that comes out of our processes to go into the ground, be it ethanol, aviation fuel, or biogas or renewable diesel. The carbon dioxide in our business model goes into the ground. We sequester it literally underneath.
So with the trucks, if it takes a long time to power a truck, to electrify it, right, to recharge the battery, that's a function of time, and that's bad for the companies delivering the products, and harder for my toilet paper to get to me from wherever it's coming from, and we were already dealing with supply chain issues. But I think it comes down to almost just basic math, which is right now, and I'm a big believer in EV cars and things like that because they're the right size, they're the right platforms. But when you come to the point of having to haul, and I have two friends and clients who own logistics companies, so we've talked about this, anything that reduces cargo load is going to be a hit to revenues and profits, and it's going to pass through to consumers. So if there could be batteries that were light enough and small enough and charge fast enough, then maybe that day will come someday. But from a technological standpoint, it doesn't look like, no matter what Elon tells us, it doesn't look like we're there. So between
the big problem isn't the vehicle itself. You can have it charge in 2 minutes.
Okay.
But where does the electricity come from? Batteries do not create electricity.
Right.
All they do is store electricity. So to me, I think the world should be about decarbonizing. It should be very simple, level playing field, guys. I'm a big fan of a truck that has fewer batteries on it because I know the carbon intensity of building that truck is significantly less than a truck that has a whole bunch of batteries, so it can go 1,000 miles. So let's decarbonize manufacturing. Let's decarbonize operating the truck. Let's use a negative 426 CI waste product, for example, as a fuel that has very low or no emissions if you want to capture the emissions, rather than something that's very carbon intensive, let's say petroleum diesel. So a level playing field forces people then to think about, okay, so if I run my Tesla on dairy natural gas, which you could do, you could take negative 426 dairy natural gas, not burn coal, not burn petroleum natural gas, not burn these things that are in the ground, but take an animal, it's a plant, the plant grew from atmospheric CO2, and you could decarbonize your Tesla by actually committing to using carbon negative electricity from renewable sources. So I think increasingly business models that recognize that and give consumers a choice are going to potentially have large growth markets.
So over the long term, how much expansion of what you're doing can go around the country? Because there's forests everywhere, not even forests, I should say orchards. There's orchards everywhere, right? And 20 years on an almond tree is actually pretty good because I've experimented with nectarine and peach trees. You're lucky to get a decade.
Yeah, that's true.
So if we're going to feed ourselves with things that grow on trees, right, we need a way to recycle that, to take that carbon, put it back in, use it for something else, replace other carbon, right? So it doesn't have to come out of the ground. The virtuous cycle that I'll show on some of these slides is just, it's so common sense. I agree across the board. It's one of the things that drew me to it. Yeah, like you said, I love EVs and everything else, but the technology to take a bigger vehicle, unless we could really go 100% renewable energy on the grid overnight, right? It's not going to work. And that transition, even though I'm bullish on it, it's going to take a really long time. So this seems to be a multi-decade process, and this seems to be one of the bridges to it.
And I think that in seeking simplicity, some journalists say, well, here's the number of EVs, electric vehicles, are going to be produced. Okay, that's very interesting. That's terrific. But did you do the basic math, which the Energy Information Agency did, EIA, right, which is how much electricity do you need in order to replace the amount of energy in transportation in the United States? The answer is real simple. About 10 times as much total energy needs to be produced in the United States, then distributed in the United States, then actually put into chargers in the United States and dispensed into all the vehicles. 10 times of what all our existing production of any sort in the United States. Well, okay, maybe you could build 10 times the number of coal plants, 10 times the number of petroleum natural gas plants. That's only 52% of the grid. You can't build 10 times nuclear power plants. We haven't built one since 1975, by the way. You can't build 10 times the hydroelectric plants in California. We can't even build one dam in 20 years because of litigation and everything else. You can't really build 10 times the solar. I know that because of litigation slow you down. And you can't really do 10 times the wind. Again, litigation. And if you could, now you've got 10 times the production, just magically got 10 times the number of nuclear reactors, 10 times the number of coal plants, 10 times of everything. So you have 10 times production. What's your real bottleneck? Distribution lines. How many national parks are we going to have to run distribution lines across in order to do 10 times the number of power lines you actually see in America today? And how many lawsuits are involved with that? And how much money is involved with that? And that's before even talking about chargers. People just pretend that magically distribution lines, 10 times the capacity of existing lines, just magically pop up. It took 18 years for the San Diego line, which is one single power line running in San Diego. It took 18 years to get that done. So I think that people just don't think about it as a overall system, which is there's no magic popping up somewhere. It's just, I have a charging station, there's magically going to be power. No, it's got to be produced by somebody from something. And so realistically, what you need is an energy dense electricity product that is easily transportable, already fuelable, already at every point where a truck is or a car is. Cars, I think, should largely electrify. But in the meantime, frankly, just use a lot of ethanol. It's renewable. The carbon came from the atmosphere. It didn't come from under the ground like gasoline did. For trucks, guys, just use renewable natural gas, use the renewable diesel product, use ethanol, use these renewable fuels, and you got yourself onboard charging for any vehicle you want, even, by the way, all the way down to the little sedans. I'll give you an example. Pickup trucks. We pull horse trailers and other things with our pickup trucks. It requires a lot of power. And it would take a lot of batteries to haul a horse trailer over the Lake Tahoe down into Reno. And so you just don't do it. It's just not on the list of things you can do is buy a battery operated pickup truck and drive for 1,000 miles. But very easily accomplished if you just put a little range extender onboard charger on the vehicle and then get all the benefits of tremendous pulling power from an electric drivetrain. So I think that this is going to be a permanent part of what we do. We're electrifying transportation, we're having electric drive, but the question is, where does the molecule come from? It should come from a liquid, transportable, renewable molecule. And that fueling structure already exists in the United States and can be very, very low cost because of the incentives around renewable natural gas. Renewable natural gas could basically be free from Aemetis anywhere in the state of California for trucking in the foreseeable future. I could see that as a business model we have. It's just free. And so I think we'll see adoption of trucks that can use that technology. And it's certainly with a fuel that's so inexpensive, 10 to 20 cents a gallon or zero, you could see rapid adoption of that approach.
So yeah, I'm sure, I know you're focused on California. There's this little place called India that you're involved with as well. What's the development in India look like?
India is a country with about 25 billion gallons per year of diesel consumption, only about 5 billion of gasoline consumption. So it's called a diesel economy, but they have virtually no petroleum. In the whole country, they have no petroleum crude oil. So they have to import either diesel or crude oil, and that costs them over $75 billion a year of US dollars. Well, that's fine if you're a US dollar country like America, that's not a big deal. But how about if you're a rupee currency? You have to trade your rupees for dollars, weakening the rupee as you're out desperately trying to find $75 billion to exchange your rupees for every year. And if you don't do that, your economy doesn't run. You don't get diesel. So they are structurally dependent on renewable fuels as their way forward. So they've already gotten stated a target of 20% ethanol blend. They've already targeted a 1.25 billion gallon, 5% blend for biodiesel. Now they're just in an implementation cycle for these things that has gone slower than we'd like. COVID hit right in the middle of them implementing these policies. But we are expecting the India economy to benefit from using domestic waste from their existing agricultural sources rather than importing crude oil and having to export rupees in order to get the dollars to do that. And so it's a structural economy very much in favor of renewable fuels and is moving very quickly on ethanol, very quickly. And I think biodiesel is soon behind there. There is certainly expected growth in biodiesel in India.
So I know that having studied this stuff for 20 years and being an energy guy that wrote on Market Watch, India is very concerned about their energy security. And, for them to have to rely on OPEC, they don't like that, right? It's just like we don't like it. I did some cursory playing with numbers, and they were so big, I had a hard time understanding them. The India market, depending on, can you finance deals, do you get approvals, all the things that go along with building, right? Would I be really far off the mark if I said that the India market, presuming you can get through all the hurdles, I mean, that could be many times bigger than what we're thinking about locally. I mean, that's not silly to think about, is it?
India has what they call the National Biofuels Policy that they passed. And in that policy, they have a 5% blend of biodiesel, which is about a 25 billion gallon market. It's about 1.25 billion gallons. That biodiesel is worth, let's call it $3 a gallon, just for easy math. So that's roughly a $4 billion per year market today. We only have less than $500 million market today. So $500 million going to $4 billion means that there needs to be $3.5 billion of extra revenue generated in India just to meet their existing step one. And in ethanol, they're already at step 3. They went from 5% to 10% to 20%. And they intend to do the same thing with biodiesel. So that's 5 billion gallons. That's about 15 billion in revenue. So we're going to go from 500 million with an M to 15 billion with a B in the course of India trying to move to domestic feedstocks and not have to import crude oil from foreign sources to operate their economy.
Well, help me out here. I'm from Wisconsin, a lot of cows here. I would imagine that Wisconsin would be a potential market for you or somebody to do similar things. In India, do they dairy farm? I mean, I just don't know how that is there. Do they also have dairy farms? Is that something you could get into, or where's that at?
The products we're making in India require renewable oil. So renewable oil can come from canola seeds, can come from soybeans, can come from corn oil. Corn distillers oil is what we produce in California. It also can come from animal sources. India is the world's second largest exporter of meat, which means it has a lot of animal tallow, is what's known as. But in India, it's a religious country. It's a Hindu country. And in the Hindu religion, the cow is protected. So the idea of having animal tallow potentially from a cow get into the food stream is religiously protected. And so we see the animal tallow industry as a very good input for our India biodiesel business. And it also, interestingly enough, is a good input for our California business. Probably the most attractive feedstock in the world is waste animal tallow. You have to refine it, though. So when it's initially made, it has components in there that are not convertible and into adequate feedstock for our plants. So what we're building in India is renewable oil refining capability. So Aemetis probably be the largest oil refiner in the country of India, based upon tallow feedstock. And the refining there is to make a very clean, very usable renewable oil that can be used in our India plant as well as in our California production facilities.
So everything takes money, and you've got a pretty interesting relationship with Third Eye up there in Canada, right?
Yeah.
Can you just tell me a little bit about how the financing works? I know that they have warrants, so that to me that's bullish because they're right. They want equity in the company. As you need more financing, and I know that you have a pretty big line right now. Does that look like it could be any impediments, or those are always right some of the biggest hurdles along with regulatory. Can you just tell me a little bit about how the financing works and kind of what you foresee in that direction?
Yeah, we have parent company financing from Third Eye Capital in Toronto. They've been funding us for over 12 years. We also have project level financing. So let's say our biogas project, we've announced we're pulling down $50 million, $50 million from a United States Department of Agriculture guaranteed loan that funds our biogas business. We expect to do another $50 million next year and end up with a total of about $200 million of financing from the United States Department of Agriculture. It's under a very common program called the Renewable Energy for America program, REAP. The REAP program is used very widely to build all sorts of different energy infrastructure on farms and process facilities, et cetera. And we're just applying it to capturing dairy methane so that it doesn't go up in the atmosphere and cause both health problems as well as climate change. So the REAP program is an example of project level funding. We also have a $125 million loan guarantee document signed with the United States Department of Agriculture for our sustainable jet fuel business. The jet and diesel plant has a $125 million document that several years of development and proving out with a facility and other things and certain of the technologies, and had to go through a big administrative process to make sure that they knew what we were doing and felt comfortable that the whole process worked. But we have financing for our projects as a result of that. So the project level financing is in addition to the senior credit facility we have, Third Eye Capital, which is in excess of $100 million. And we've already announced another $100 million increase on that. I think we announced that less than a month ago. So our total credit facilities with Third Eye are in excess of $250 million, including this new financing that we have not closed the paperwork on.
Yeah, one of our investments that we made several years ago was Kinder Morgan. And it was because a couple of things were happening. One, the stock price got beat up because of, things that happened in the oil market and all the way back to the financial crisis. But when I take a look at natural gas pipelines, I was like, this is a play on the energy transition, not just away from coal to natural gas and then eventually to more alternatives, but one of those alternatives is hydrogen. And hydrogen is an interesting thing if you can do it green, right? It's if the blue hydrogen, I don't know what the big benefit is there, but the green hydrogen, if you can get there, is right. It's pretty interesting. Yeah. Kinder Morgan did something several years ago that they hadn't been doing. They had been building a lot of their projects on spec, right? Let's commit to the project and start spending money and not know if we could finish it or make a profit on it. It seems to me that what you're doing is the opposite, and what Kinder Morgan converted to, which is having the money up front, essentially, or a lot of the money up front, so that you're not, building a spec house, right? I mean, I think that's the way a lot of people could think of it. So I like the way that you're financing it. It's something that I really pay attention to because, down the road, we've got to have the free cash flows to share with shareholders. Otherwise, it's a great idea, but is it investable? As folks know, I've been putting my money where my mouth is, and like I said, I think our group of a few hundred investors is the majority of the put selling in your stock. So while people are buying puts because they just don't understand what's going on, and that's good for us, right? I love an inefficient market. We've been accumulating shares. I think we got people who have a net cost on your shares way down in the single digits, and they're just looking at this like, wow, 6 months is what we did. I'm taking a look at what you're doing, and I'm trying to do the math, And, the other day I was in the Houston airport, and the first thing I see is a Chevron advertisement talking about similar things. So clearly this is going mainstream, and we're early on in the process. And I know that investors have a hard time thinking a few years out, right? They want to know what's my return going to be this year. And they don't think about the S curve and the hockey stick, and they just think, well, I can't wait 3 years. It's dead money, blah, blah, blah. Well,
Yeah.
I thought the same thing 20 times. I got over 20 10 baggers in my career. And, I think that the right way to think about investing in Aemetis, I've said it wrong like 3 times, but
That's fine.
it is, I think we have to look at the process that we're going through here, and how big this total addressable market is. I just don't think people can wrap their heads around the size of the agriculture market, the energy market, all these things coming together, playing together, and not just in the United States, but to me, and again, the people who read me know my feelings on India. I think that India is almost going to be the linchpin in the global economy for the next generation or two. Who knows, a long time. I mean, as an investor, to me, that's forever. So, I love that you're invested in India. I saw that one of your plants is using solar, and I know that Nevo, way back when, had some solar chops. Is there anything beyond just using the solar that's part of your business model? I mean, is there anything else that you can use that for, or is it just a way of having low cost clean energy for the tax credits and the energy?
Yeah, we're primarily using solar to reduce the amount of carbon in our ethanol. So lower carbon intensity in ethanol means we get more credits in California, and that's worth cash to us. So we are also using, let's call it electrification in our ethanol plant business. We're changing, for example, the distillation process, the process of taking the ethanol and the water and separating them. And we've already installed and now are commissioning the world's first implementation of the Mitsubishi ZBREX equipment. It's about 5-story tall process unit, but it does not use much steam to operate. It uses electricity primarily. And it pushes the ethanol and the water through ceramic tubes to separate the two, rather than what used to be a very carbon intensive process using petroleum natural gas of putting it in a vacuum and then pressure and a lot of temperature involved. And so we've moved away from petroleum natural gas to electricity. And then the electricity sources are for us zero carbon intensity hydroelectric, so power from a water dam, and negative carbon intensity dairy renewable natural gas. So we make electricity, but we make it from carbon negative renewable natural gas and carbon zero water running through a dam. And so that decarbonization, of course, we get paid for every day, because now our ethanol actually has lower carbon in it, and we get paid more money if we have a lower carbon intensity fuel.
Okay. That's interesting stuff. I guess I have just 2 more questions before we go. The first one is Nevo. You talked a little bit about the range extenders. When I look for investments, I'm looking for things that the market just completely overlooks. I think that most of the company is overlooked, but at these prices, is there anything with Nevo that we can think about at this point?
Nevo is an entity that Aemetis has an ownership position in, and we are very interested in demonstrating how this technology actually applies specifically to trucking, because of the lack of battery or hydrogen fueling infrastructure anytime soon, but the very real renewable natural gas infrastructure and ethanol infrastructure. So if we are able to demonstrate electric vehicles, larger capacity trucks specifically, that can go 1,000 miles, but are running on electric motors and have the 90% efficiency of electric motor, low maintenance of electric motor, but are on low carbon or negative carbon fuels. So the footprint of that truck potentially is the more miles you drive it, the lower carbon greenhouse gas exposure you have in the atmosphere. That's what the Nevo truck company is really built to do. And we've been very steady on rolling that out. We were delayed a little bit with Build Back Better. There's some policies in there that would be very, very attractive, but there's some very, very supportive policies that are already a part of law, including a lot of funding from the Department of Energy, et cetera. So we're moving at what I consider to be a very steady pace in demonstrating how a onboard charge structure in a electric truck is much better than having to have all this charging infrastructure, and parking trucks for so long and having all this dedicated real estate and drivers sleeping during the day waiting for their truck to get charged up and all this activity, which I don't think is ever going to happen in the real world. I think the real world people will be looking for low cost and high uptime. So less maintenance means better uptime. Lower cost comes from lower cost fuels. And that's exactly what renewable fuels offer in the structure that Nevo Motors is developing.
The future of trucking is interesting to me. It just kind of blows my mind. Again, the big picture, supply chains moving, everything else, clean energy transition. In the future, the trucks are going to at least partially drive themselves on highways. That's already, I'm seeing that with Foxconn and Amazon here in Wisconsin. And, if they can geofence something, the AI and everything can handle simple driving. So highway driving will probably fit that. In the future, the uptime part of that equation is a big deal, because then the trucks can get there faster. They can be more on time. It's better for the supply chain. And I agree with you. As much as we all want to be the perfect consumer, the most efficient, a lot of times it comes down to the sticker tag, right? The sticker price. So
that's right. Yeah.
All right. So I have one last thing. I'm presuming that all you reduce the carbon guys hang out at the same, beach or nightclubs or golf courses. Do you happen to know the guys over at New Light Technologies with the carbon fiber?
In Costa Mesa, California?
I believe that's where they are.
Yeah, Mark and I met 10 years ago.
Really?
I've been down and visited with them. Yeah.
Interesting. That's a company that I've been hoping would go public for a long time.
Yes.
So I'm curious to see what goes on with that, but I think that you with Aemetis and then New Light, and there's a dozen other companies I keep an eye on, that some are private, some are public, a couple are SPACs, so everybody hates those right now. I believe that basket, which you're part of, and I don't know which ones they will be, but one of the messages I have for investors is, look, if you can buy the basket, those 8, 10, 12 companies that seem to be leading the pack, first mover advantage like you have, and you've got great geography. I mean, where you're starting is it's unusually good. And I talk about how America has the best geography on the planet, right? You might have the best geography what you're doing. So I think that gives you an advantage. Do you foresee moving to other geographies in America? Texas, Wisconsin, I don't know where else. Are there other opportunities that might pop up?
Currently, the low carbon fuel standard in California is a very, very big market that, frankly, if we did something in Texas, it's because we're going to send the product to California, right? There's no Texas low carbon fuel standard, for example. Right. So the developments happening around the country is really to sell the market into California, to a lesser extent, Oregon, Washington, maybe a little bit of British Columbia. But we are seeing low carbon fuel standard policies being discussed by New York and some other northeastern places. So if we see a unique opportunity show up, we'd certainly consider it. Right now, we're seeing such synergy between our operations in California, all of which are within 50 miles of each other. Right. That we can crank out, frankly, more than $500 million a year of positive cash flow when you include carbon sequestration in it. And we just think that we should dominate. We should own the area where our dairies do business. We should own the San Francisco airport. There's no reason for any other supplier to supply the San Francisco airport. And with probably $4 billion, maybe $4.5 billion of contracts, we're going to largely be the supplier of aviation fuel, certainly at this first phase, to the San Francisco airport. And we're just doing things that solidify our position in the marketplace. And then that synergy, that circular bioeconomy, where a product of one of our processes as a waste product becomes the feedstock for another one of our processes, that kind of sustainability is very, very profitable, very profitable. So we are committed to maximizing how our existing footprint as the largest ethanol producer in California, the largest animal feed producer in California, the largest distiller's grain producer in California. These are the things that actually allow us to build the largest dairy biogas project in the world, the largest sustainable aviation fuel plant in California, to our knowledge, and one of the largest renewable diesel plants in California. So we're coming from a position being already pretty significant in terms of what we are compared to the market in California. And so we're just intending to extend that as much as we can.
I'm trying to express this to people because the folks who read me know that I've been an energy guy a long time, and I've been studying this stuff since when I was a kid almost. This is truly, this is one of my top 20 picks for the next 5 years. And I know everybody says, well, what about 2022? I don't know. I don't know how Apple's going to do in 2022. But, I love that you're early. I love that you're, I think, about the only game in town at this point. I don't fully believe that most people in America understand the size of the California market and the surrounding areas. Then you throw in India and how that might go, and potential for Nevo. I really appreciate the time today. I hope that the folks listening get a better understanding of not just this company, but the broad market in general. One of our things is look for big total addressable markets. Holy cow, man, you've picked out a pretty big total addressable market. I really do appreciate it. This has been great. So for everybody, thank you to Eric McAfee at Aemetis in California, and let's just keep cleaning up the planet.
Great. Thank you, Kurt. Appreciate the time.
Yeah, have a great night.
All right, just a quick epilogue here for that interview with Eric McAfee with Aemetis. Here's a look at the chart for Aemetis, and you can see that it's had a couple of spikes, part of the whole hype cycle thing. Now what we're seeing is there's pretty clearly support in that $10 range. Could it go down to 6 or 7? Absolutely. People can have fear for whatever reason. Maybe people who look at the financing start a narrative and they decide that we're going to talk it down before a lot of people know about the stock. That's definitely a possibility. If it gets down to 6 or 7, I'll really consider making it a double position, which I don't do very often. I only have one double position on right now, and that's a company undergoing some major M&A. Other than that, I usually have starter positions and half positions on, and then a handful of full positions. With my cash secured puts, Aemetis will probably be a full position imminently, and on any volatility, I'll buy it up just to make sure it's a company that I want to be involved with. Quick note, the EIA, for the first time ever, started keeping track of biofuels in their short-term energy outlook. So it's clearly a growing area, and the growth rate is above 7% compound annual now and accelerating. So it looks like it'll be a compound annual growth rate in the low double digits in the not too distant future. As that occurs, more and more people will come to invest in it. So you're early to the game. I really encourage you to think about whether this belongs in your portfolio. If you have a growth sleeve, it probably does. All right, take a look at the disclaimers. Everything here is future looking and no guarantees of anything. So have a great rest of the day, and take a look at Aemetis' website and the new presentation, as well as the couple of older ones on the scientific side. Take care.